Views expressed are solely those of the speakers and do not represent this show or its team.
Bitcoin is a speculative asset that is outside your portfolio. Gold and precious metals are a less speculative, but more long-term hold as a hard money asset that will keep pace with inflation over time. And your house isn't an investment at all. It's a domicile. It's where you live. It's where you raise your children. And it's a lifestyle choice.
Welcome to Built to Last, conversations about wealth, work, and life. I'm Wade Lopez, and I'm joined by our Chief Investment Officer, Gary Aiken. Okay, so let's just say it out loud. If you've been paying any attention to the news lately, three things keep coming up over and over again. Bitcoin, gold, real estate. And depending on what you read, one of them is the greatest investment opportunity for generation, one is in a free fall, and one is completely broken. And you're usually the same person saying all three things at the same time. Here's what is actually happening. Gold hit an all-time high of roughly 5,600 per ounce in late January this year. Then it pulled back sharply and is now sitting under 4,000. Bitcoin ran up past 100,000, came down hard, and it's trading in the low 60,000 range right now. And real estate, man, inventory is slowly improving. Prices are essentially flat nationally. Mortgage rates refuse to come down, and yet the housing market has not collapsed the way some people predicted it would. Three very different asset classes, three very different stories, but underneath all of them, there's a common thread. People are trying to figure out where to put their money in an environment where inflation is real, interest rates are elevated, geopolitical risk has not gone away, and the rules feel like they keep changing. Gary, let's start with a question I think most of our listeners are actually asking. When everything feels like it's moving at once, what does a disciplined investor actually do?
Well, I think a disciplined investor needs to go back to what their fundamental process is, of course. And our process is to look at global macro trends that are going on. And I think that those global macro trends are going to be really important for all three of those asset classes that you talked about. And then the next thing is we needed to look at the technicals of them, because these types of investments, gold, Bitcoin, and real estate, really have a lot of technical factors that the average, like common stock and normal bond portfolios. So they're definitely things that we need to talk about with relation to each of those that we wouldn't talk about necessarily talking about stocks and bonds.
Well, okay, let's start with the gold, because this is the one that has had the most dramatic swing in the shortest amount of time. Gold hit 5,600 in January 28th. That was a record. It broke through a price ceiling that many analysts didn't expect to see broken, certainly not this fast. It was also the first time in real terms, adjusted for inflation, that gold exceeded its 1980 peak. That's a meaningful threshold. And then over the following 5 months, it fell more than 20%, and it's now sitting at around 4,000. Gary, what do you think drove gold to 5,600 in January, and how much of that move was structural versus just simply being emotional?
I think what was driving gold was a number of things. First was certainly central bank accumulation of gold. With the dollar sort of falling last year and political unrest in the U.S. and political turmoil sort of around the world growing, I think there was a desire on the part of many central banks around the world to shore up their non-dollar reserves, and one of the places they get that is from gold. Secondly, we did have additional industrial demand because of the AI boom. Gold is a great conductor, and so it's used in industrial purposes in semiconductors and other types of chip-related places in the industrial complex. So you had those two things going on, and then of course there were, the retail investor really got into it, and that was driving flow of funds to gold ETFs and gold mutual funds. And I think those three things combined, central banks, semiconductors, and the retail investor really getting involved. Those are the things that drove gold up to its recent peak.
Well, like you just said, central banks, they were buying gold double their pre-2022 pace. In fact, China purchased something like 317 tons in the first quarter of this year. That's not speculation. That's a sovereign, government decision that talks about reserve diversification. What does that tell us about the underlying demand story for gold?
Well, when we look at underlying demand and going by some of the banks that I follow, J.P. Morgan, Goldman Sachs, they say the demand picture for gold is still very strong. Central banks are going to continue to buy. I have a different viewpoint on that, which is that when the war in Iran began and oil became scarce, um, I think all of these trends sort of turned on their heads, right? There was a flight to safety in the dollar, and the dollar going up really put pressure on non-dollar reserves. And if you were a country that needed to secure oil, you needed to buy that oil in dollars, and so you needed dollars again. And where was the place where you could sell something in dollars to get dollars to buy oil and other commodities? That was gold, and I think that was probably the major reason why we saw gold fall precipitously once the war began.
The conflict drove inflation expectations higher, which caused the Fed to signal the rate cut. But you know, that was basically off the table, and possibly even hikes may be coming. Higher rates increases the opportunity, or increase the opportunity, I should say, for the cost of holding gold, right? So walk us through that relationship, because I think a lot of people don't understand why gold and interest rates can move in opposite directions.
Yeah, I think it's pretty confusing, and frankly, it's confusing to me sometimes too, because
Yeah, me too.
you hear this story that gold is an inflation hedge, correct? And over long periods of time, that is true, or has proven to be true in the past. But in the short run, we saw inflation start to spike and interest rates start to spike, and you would think that that would be a place where gold would also go up too, because it's an inflation hedge. But gold went down as inflation was rising, so it wasn't a very good inflation hedge once the inflation started to reemerge
Right.
around the world. So it's sort of a conundrum, and that's why when we talk about that it's different than stocks and bonds that have a pretty obvious relationship to interest rates and inflation. Um, gold is a little bit more leading into and then selling, more of a buy the rumor, sell the news, maybe, with regards to inflation and interest rates.
Well, you mentioned J.P. Morgan a minute ago, and they still have a year-end target of like 6,000 an ounce. Goldman Sachs is at 4,900. So even the more conservative bank forecasts are saying gold is undervalued right now relative to where they think it's going. How should investors think about a situation where the asset is pulled back significantly, but the structural case has not changed?
Yeah, if you believe the structural case hasn't changed, and a lot of those banks were also moving their price targets up at the same time that gold was breaching previous price targets.
Mm-hmm.
So we need to be careful about what price targets are. But I think structurally, now that the war potentially is winding down, and maybe we'll start to see a reversal of the trends from the war, we may see a resumption in the dollar declining and gold going back up again. And central banks may need to may go back to sort of gold accumulation. So I think the demand picture, the story hasn't really changed very much. So those price targets, I guess, if they were reasonable, and gold is trading slightly below those, it presents some discount to fair value.
Peter Schiff's been right about gold for a long time now, but Grant Cardone is pairing real estate portfolios with Bitcoin on the same balance sheet, and Robert Saki is telling everyone to buy silver. every high profile investor seems to have a different answer right now. How do you cut through all that noise?
Well, silver is a completely different story. Silver has more industrial uses. It's also significantly more plentiful than gold. Um, easier to get at in different places, and so there was a run up in silver sort of because there was a run up in gold, and of course silver being more volatile, had an even more extreme move than gold did. Um, you know, but is there a place for precious metals in client portfolios? Yeah, I think so. One rule of thumb potentially is have sort of 1% or something small in physical gold and silver, and monitor that outside of your investment portfolio, and then if it drops below 1% of your portfolio, then buy a little bit more in the open market. But going to Costco and buying an ounce of gold at $5,800, you should be prepared to hold it for a long time.
For at least a little while. So I'm talking about your favorite topic here. Let's jump to Bitcoin. It hit 115,000 mid 2025, which was an all-time high. It ended last year down about 30% from the peak. It's currently trading in the low 60 range, which still represents a stunning multi-year return, but it's down dramatically from where it was, and people, they're feeling it's everywhere, right? We feel like it's all over the map. What has changed in the last 2 years is kind of the institutional landscape, right? Spot Bitcoin ETFs were approved in the US in January of 2024. Companies have been adding Bitcoin to their corporate balance sheets. Some governments are having conversations about it as reserve assets. That is a fundamentally different environment than the Bitcoin 5 years ago, but the volatility is certainly not gone away. Gary, does the institutional adoption of Bitcoin over the last 2 years represent a genuine change in what Bitcoin is? Or does it simply mean that more sophisticated investors are now participating in the same volatile speculation that has always defined the asset?
Yeah, I don't think the entrance into the Bitcoin market or the structures, ETFs, mutual funds that are entering into the Bitcoin market change the fundamental nature of Bitcoin. It has never lived up to, or at least it hasn't yet lived up to, this idea that it is an alternative currency to the dollar. We're still trying to figure out how to use tokens and coin alternative coins in terms of dollar alternative assets, whether they're stable coins and things like that. But Bitcoin itself, I think, has some structural disadvantages that make it sort of impossible to be a true currency, and so it
Right.
is a speculative asset, um, and a speculative asset with an extreme amount of volatility.
Some analysts compare Bitcoin to digital land, a fixed supply asset that appreciates over time as demand grows. Others compare it to the dot-com bubble, real technology, but wildly overpriced relative to current utility. How do you frame the debate in a way that is actually useful for investors?
I think the way we framed it in our April 2024 piece was talking about it as a more like a commodity.
Right.
You mine it, although not with picks and shovels, but with mathematical computation. And so in order to mine a new Bitcoin or a fraction of a Bitcoin, you have to use an extreme amount of computing power and electricity. And so if you look at the cost to produce a new marginal Bitcoin, you'll find that the cost is now slightly above the price of a Bitcoin. So if you
Right.
look at a website like Hashdex, where you can find this information on the profitability of Bitcoin miners, you'll see that they're actually every time they mint a new Bitcoin, they're losing money. So when we talked about in April 2024 that we would find it, if it was a true commodity, we would find it attractive when it was priced below the marginal cost of production. And I think we're there right now. That doesn't mean that we're that we're buying it for client portfolios or recommending it, but when it was at 115,000, we thought it was very overpriced, and at 60,000 or below, it's either fairly priced or at a discount to at least the marginal cost to produce.
Gary, if a client came to see you right now and said, I want some Bitcoin in my portfolio, what's the framework you would use to have that conversation responsibly?
I think the framework would have to be, let's set aside some fund money that you don't mind losing almost 100% of your money if it goes to zero,
Yeah.
which is a possibility. Um, and whatever amount of money that is in, we would say, hey, take a look at where the price of Bitcoin is relative to the marginal cost produced. If you can buy it below that, that's a decent entry point.
Good deal. So let's talk about real estate. Here's the headline. The national housing market is essentially flat. Zillow puts the average home value at approximately 370,000, up less than 1% over the past year. JP Morgan Research is calling for zero price growth nationally, and yet mortgage rates are still above 6% on a 30-year fix. Affordability is still stretched. Monthly payments have roughly doubled since 2021, and the inventory shortage that has defined this market for the last several years is only slowly starting to erase. Here's what makes the real estate story unusual for me right now. The market has not crashed, which many people predicted it would when rates went from 3 to 7. It did not crash because people who locked in 3% mortgages are not selling. That lock-in effect has kept supply artificially tight for 3 years, and it's the single biggest reason prices have remained elevated even as affordability collapsed. So, Gary, how do you explain the housing market to someone who's expected, that doubling their monthly payments will cause prices to fall significantly, and yet that just simply hasn't happened?
I think it's supply and demand, Wade. We're not building a ton of houses, and the like you said, the people who refinance their mortgages are not moving, so there's not a whole lot of new supply on the market, and that's
Right.
keeping prices elevated. There's not a whole lot of new construction, and there's not a whole lot of used houses, coming on the market to support the number of people who want to buy. And so in a supply constrained environment, we can see prices sustain, even though rationally speaking, we would expect maybe prices to decline.
The inventory is up about 7 to 8% over the year nationally. 9 states are now back above their pre-pandemic 2019 levels, including Tennessee, Florida, Texas. But the Northeast and Midwest are still tight. How does regional divergence change the real estate conversation for you?
You know, there's that old adage, all real estate is local.
Right.
And I think investors in real estate need to consider that each of these localities is different. Certainly in the Northeast, I would think with populations declining or people moving to the Southeast and to the West, that there isn't a lot of new. There's probably less new supply, but in places like North Carolina, in Florida, where there has been an influx of people and an expected continued influx, there's probably been more development. Plus, those jurisdictions are probably more favorable to real estate developers as well. And so, money will flow and development will flow to places where it encounters the least friction. And so those are places where you're more likely to get excess if the buyer demand doesn't materialize.
Yeah. Yeah.
So
I
each of
agree.
these locations has a specific sort of set of circumstances around it, and so taking it at a national level is kind of difficult.
Yeah. One of the very unusual dynamics right now that we're experiencing is that median resale home is more expensive than the median newly built home. That's only happened, I think, a handful of times in the last few decades. Builder incentives, rate buy downs, new construction is happening, have all contributed to that. What does it mean for people deciding between buying existing versus new?
I think it's a personal decision. You know, your home is your domicile. It's where you live. It's a lifestyle choice. I don't think it should be thought of as an investment. If we look back over the long term, houses have generally appreciated at about 0.5% above inflation. You know,
Mm-hmm.
we would expect bonds to be about 1 to 2% above inflation and stocks to be 4 to 5% above inflation. So, you know, houses are not typically a great investment for a long-term appreciation. You get all of the appreciation, you know, in your pocket at one time when you sell. So you look at it and you say, wow, that's a lot of money. But investing the same amount of money in the stock market or the bond market would have yielded a higher return over
Right.
time.
So, how should investors be approaching deals differently right now?
I think investors should be thinking about the dynamics of, you know, whether new construction is going to pick up, and the direction of inflation and interest rates,
Yeah.
especially when we look at buying home builders or home builder adjacent things like Lowe's and Home Depot. Right? Those are all, they're all sort of struggling right now.
Well, what's going to happen if the Fed has you raise rates to combat inflation? What's the realistic scenario for real estate over the next 18 to 24 months?
I think the outlook is probably that things are going to be relatively flat. You know, I don't think that the Fed is going to have to raise interest rates dramatically, if at all. But I don't think there'll be a huge case to lower interest rates dramatically.
Was there a path where the market finally cracks, or is the structural sorters so significant that the prices are going to remain somewhat sticky no matter what?
Yeah, I think prices remain sticky.
Okay.
There hasn't been a whole lot of, you know, lending to unqualified buyers like we saw in the run up to
Right.
2007,
I agree with that.
2008.
Yep.
And so you have more qualified buyers, you have a stickier lending market, and you have population dynamics that you know, aren't super favorable. Um, and I think those are reasons sort of not to be super bullish on the price of housing, but also because it's sticky, not super bearish either.
Yeah. Here's what I find interesting. When you put the three assets side by side, yeah, gold, Bitcoin, real estate are all fundamentally, stores of value. If you think about it, they're all things people buy when they're worried about the purchasing power of the cash. They're all inflation hedges in theory. And yet right now in the same macroeconomic environment, gold has fallen 20% from its high. Bitcoin is down more than 40%. And real estate has barely moved at all. The same macro environment produced three completely different outcomes. That tells you something important. In my mind, these assets are not interchangeable. They respond to different forces on different timelines, different risk profiles, and different liquidity characteristics. The mistake is treating them like they're the same thing because they're all getting described as inflation hedges. So, Gary, if you had to describe the right role for each of these three assets in a well-constructed financial plan, what would that look like for the typical client we serve?
I think the way to approach them is that Bitcoin is a speculative asset that is outside your portfolio. Gold and precious metals are a less speculative but more long term hold, as a hard money asset
Mm-hmm.
that will keep pace with inflation over time. And your house isn't an investment at all. It's a domicile. It's where you live. It's where you raise your children, and it's a lifestyle choice.
Yeah, so how do gold dropped 20, people panic to sell, Bitcoin drops 40%, people think it's over. Real estate feels stuck. How do you help clients separate price movement from the underlying case for an asset?
I don't think you can. I think we look at
Yeah.
prices and
Right.
technicals really, really importantly, right? If you're going to trade an asset that has zero cash flow,
Yeah.
like gold or like Bitcoin, then you almost certainly have to trade it on flows and technicals.
Right.
And so if we take a look at the technicals and the flows on Bitcoin, you can make a case that it's attractive at this level. If you
Right.
take a look at the price of gold and its price movement and the technicals and what we anticipate flows will be, you could also make a case that given the recent pullback in gold, that it's fairly attractive as well. So I think that's one way to look at it. And I would say the same thing if you talk about investment real estate as well, that now that you've converted it from a place where you live to something where you're hoping to get rental income from, I think then you can make a determination as to whether an individual investment is attractive or not based upon the cash flows that you expect to get from that.
We're in an environment where inflation's above target. Geopolitical risk is real. Fed's signaling it may have to raise rates, and the national debt trajectory is genuinely concerning. That is classically the environment where hard assets are supposed to perform. Yet 2 of the 3 of the hard assets are in meaningful pullbacks right now. What does that tell us about the limits of the inflation hedge narrative?
I think it turns it on its head, and to be kind, and makes us want to take a step back from that as a conventional wisdom item and say, well, maybe this is another example where the conventional wisdom is wrong.
Right. All right, Gary, let's bring this thing home. We've talked about gold at an all-time high and now in a sharp correction. Bitcoin is off peak. It's sitting in a very different environment than it was 2 years ago. And real estate market has basically defied the prediction of the people who were calling for a crash, right? So the 3 questions we always end with, right? What is the single most important thing that matters right now when it comes to how investors should be thinking about hard assets like gold, Bitcoin, and real estate?
Technicals and flows.
Right. All right. What are you watching over the next 6 to 12 months that every person in this audience should have on their radar?
I think with relation to Bitcoin and gold, I think people should take a look and see if the fundamental story around both of those continues to hold. With Bitcoin, if it's going to survive, then the next halving event is in 2028, and we would expect the price of Bitcoin to rise dramatically into that halving, as it has every other time in the history of Bitcoin. So it's either going to go to zero or it's going to go much higher from here. So I think that's something to look at.
All right, last one. What's the one thing investors absolutely need to avoid right now when it comes to these 3 asset classes?
I think the one thing that investors need to avoid is investing in binary outcomes. And that's the reason that we've never invested in Bitcoin and probably will never invest in Bitcoin directly for clients in client portfolios. Binary outcomes, any time you can lose all of your money, and the reason for losing all that money is something that you can't possibly foresee or plan for. I just don't think that that's an investable asset class.
I agree. Noise around Bitcoin, gold, and real estate right now is extraordinarily loud. And a lot of that noise is driven by people who are just trying to sell you something, whether that's a newsletter, a fund, a course, a theory about the collapse of their dollar. The louder the pitch, the more skeptical you should be. What does not change, regardless of which of these 3 assets you were talking about, is this: purpose matters. Every asset in your financial life should have a reason for being there. It should serve a function, whether that is growth, income, inflation protection, liquidity, or legacy. When you are clear on the purpose, price volatility becomes a lot less frightening. When you are chasing performers without clarity on purpose, every move in the market feels like a crisis. If today's conversation raised questions about where gold, Bitcoin, or real estate fits in your specific financial plan, or whether any of them should be there at all, That is exactly what our team of Comply Wealth Partners is here to help you with. Gary, great conversation as always.
Thanks, Wade. See you next time.
Yes, sir. And that's exactly why we call this Built to Last. See you next time.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.